While the rest of the world was watching fireworks and toasting champagne last night, I was watching something far more explosive. At exactly 9:30 p.m. Eastern, while you were pouring your second glass, the silver market didn't just close, it was demolished. I'm a private commodities analyst. I've been stacking physical silver and trading metals for 12 years. I built this channel because I got tired of waiting half a day for Bloomberg to tell me what I already saw happening in real time on my terminal. And lately, with all these AI avatar channels pumping out recycled hype and fake news about silver, someone needed to cut through the noise with actual data. So here we are. Let me show you what happened in the final hour of 2025. Silver didn't gently drift down to close the year. It was systematically destroyed. The spot price hit $71.39 by the time the ball dropped. That's a 5% massacre in the final act of a year where silver was supposedly the hero, up 150%. You're going to wake up this morning, January 1st, and see headlines praising silver's historic year. Best performance. Since 1979, they'll say. Routine. Year-end volatility, they'll reassure you. They're painting a victory lap while completely ignoring the blood on the floor. But here's what they won't tell you. The real story isn't the 150% gain. The real story is the $31 billion life support machine that the Federal Reserve switched on at the exact moment silver hit a brick wall at $83. This wasn't a market closing. This was a market liquidation, and someone, somewhere, needed an emergency bailout to survive it. They want you to think the fireworks were for the new year. But for the banking system, they were celebrating the fact that a $35 billion fire almost burned the whole building down, and they managed to put it out just before midnight. Here's my thesis, and here's what I'm going to prove to you in the next few minutes. The sudden violent rejection of silver at $83 and the record-breaking $31 billion Fed repo injection are not coincidental. They are twin signals of a massive institutional insolvency event that was papered over in the final hours of 2025. We are looking at a complete decoupling between what I call the street price and the Western screen price of silver. The system is physically empty but digitally manipulated to protect institutions that are drowning in failed short positions. I'm going to walk you through the exact mechanism they use to hide this mess. It's called year-end window dressing, and it's the financial equivalent of shoving all your dirty laundry into a closet 5 minutes before your mother-in-law shows up for inspection. I'll run the actual math on that $31 billion bailout and show you why the numbers point to a specific, localized failure in the metals market. And then I'll tell you exactly what I'm watching this week and what my conditional plan is for the first 7 days of 2026. Let me give you the on-the-ground reality of what I was looking at a few hours ago. Silver closed at $71.39 bid, $71.80 ask, a brutal 5.07% drop in what should have been a quiet final session. Gold, by comparison, was down just 0.5%, sitting at $43.16. Gold was steady, silver bled. But here's the key level you need to understand. Silver hit $83 earlier in the session. Look at the candle formation. It's what technical analysts call a shooting star, a massive upper wick that shows complete and total rejection of higher prices. That's not retail investors taking profits. That's institutional selling. That's the dump button being pressed by someone who had no choice. Now let me show you the real divergence. The screen says $71, but the street tells a completely different story. I've been hearing rumors, unconfirmed but consistent, of physical silver trading at $130 in Tokyo, $106 in Kuwait. These aren't conspiracy theories. These are whisper numbers from dealers who are scrambling to source metal. If you can't actually buy a bar of silver for $71, then $71 isn't the price. It's a suggestion. It's a number on a screen that has decoupled from physical reality. Stop for a second and look at that chart again. That vertical drop at 9 p.m. That's not profit taking. Profit taking is a slow exit over days or weeks. This was a forced liquidation. Someone hit the eject button. But why would they dump it now? At the exact moment of peak momentum? After a 150% run? Because they had no choice? And here's why. Let's pull this apart. I need you to understand a mechanism that most retail investors have never heard of, but it's the key to everything that happened last night. It's called year-end window dressing, or regulatory deleveraging. Here's how it works. At the end of every fiscal year, banks and financial institutions have to report their balance sheets to regulators. They need to show that they have enough capital, that their leverage ratios are within acceptable limits, that they're not overextended. It's like a report card, and the snapshot is taken at midnight on December 31st. Now, if you're a bank and your books are messy, if you have risky positions that look bad on paper, you have two choices. You can actually fix the problem, which takes time and money, or you can temporarily hide the problem just long enough to pass the inspection. Think of it like this. You're a teenager, and your room is a disaster. Clothes everywhere, trash piling up, evidence of things you shouldn't have been doing. Your parents are coming home in 5 minutes for a surprise inspection. Do you actually clean the room? No. You take everything, all the mess, all the evidence, and you throw it into a single closet. You shut the door, you lock it, the room looks pristine, you pass the inspection, and then tomorrow, when they're gone, you open the closet back up and deal with the mess. That's window dressing. And on December 31st, the Federal Reserve's $31 billion repo injection was that closet. Here's what I think happened. A major institution, probably a bank, was massively short silver. They likely built this position when silver was trading at $30 or $40, expecting it to fall back down. Instead, it ran to $83. That's a catastrophic loss. At $83, they were staring at margin calls they couldn't meet. They were insolvent on that single position. So what did they do? They dumped the position. They sold into the market aggressively, driving the price down to $71. That selling pressure created the illusion of a bearish market, and it also reduced their mark-to-market losses just enough to make their balance sheet look acceptable for the midnight snapshot. But here's the problem. They still needed cash. They still needed liquidity to meet their immediate obligations. That's where the Fed came in. The Fed provided a record $31 billion repo injection, the largest since the COVID crash of March 2020. That cash allowed the bank to settle their debts, square their books, and present a clean balance sheet to regulators. This means the price drop wasn't a reflection of silver's true value. It wasn't the market saying, silver is worth less now. It was a regulatory hide-the-mess maneuver. The price was manipulated down to save a failing institution. And here's the kicker. The problem with the closet method is that eventually the door has to open back up. Eventually the mess comes back out. And that's what we're going to see in January. Let me run the actual math for you, because the numbers here are too precise to be coincidental. The Federal Reserve injected $31 billion into the overnight repo market on December 31st. They're calling it seasonal liquidity management. They're saying it's just standard year-end plumbing, nothing to see here. But let's look at the historical context. The last time the Fed injected this much cash into the system was March 2020, during the COVID liquidity crisis. Before that, you have to go back to September 2019 during the repo crisis that nobody wanted to talk about. These are not normal events. These are emergency interventions. If this was truly just seasonal plumbing, why is it the largest injection since a global pandemic? The numbers suggest a liquidity deficit far beyond routine. Now let's run a stress test. Let's assume a major bank was short silver from $30. Silver runs to $83. That's a $53 move against them. If they were short, let's say 600 million ounces, which is not unreasonable for a major institution, they're looking at a $31.8 billion loss. Round that up for margin requirements, forced liquidation costs, and you're looking at a $35 billion hole. The Fed injected $31 billion. The rumored short loss is $35 billion. The numbers are almost identical. This isn't the Fed just providing liquidity. This is the Fed effectively covering the bet for an entity that couldn't pay. Now compare this to the official narrative. The Fed says this is seasonal. The mainstream media says silver dropped because of profit-taking after a strong year. But the math doesn't support that. If it was profit-taking, you'd see a gradual decline over days or weeks. You'd see a healthy redistribution of positions. Instead, you saw a vertical drop in a single hour, accompanied by the largest emergency cash injection in 5 years. The numbers don't match the seasonal narrative. The math points to a specific, localized failure in the metals market. Someone was drowning, and the Fed threw them a $31 billion life preserver. But I know what the skeptics are going to say. Let me steelman their argument because it's important to address. The skeptic says this is just year-end profit-taking. Silver went up 150% in 2025. Traders are closing out massive gains to lock in bonuses. The banks need liquidity to process those withdrawals, so the Fed provided it. It's standard operating procedure. No conspiracy needed. On the surface, that sounds reasonable. But let's dig deeper. If this was just profit-taking, why did the COMEX simultaneously raise margin requirements to $25,000 per contract? That's a massive increase. If the market is healthy, if this is just routine profit-taking, you don't need to force small players out with prohibitive margin hikes. Margin increases are what you do when you're worried about systemic risk. They're what you do when you need to reduce open interest fast. Profit-taking is a slow exit. It's traders gradually unwinding positions over time. This was a forced liquidation. This was the market equivalent of a fire alarm going off and everyone running for the exits at once. And let's address the myth that the Fed doesn't care about silver. The Fed doesn't care about silver as a commodity. You're right, but the Fed cares deeply about the banks that hold silver shorts. If a major bank fails because of a metals position, that's a systemic risk. That's a contagion event. That's exactly the kind of thing the Fed was created to prevent. So let me recap where we are. Silver hit $83. A bank likely went insolvent on their short position. The Fed pumped $31 billion into the system to provide emergency liquidity. The bank dumped their silver position, crushing the price to $71, just enough to make their balance sheet look acceptable for the year-end regulatory snapshot. The window was dressed, the closet was closed, the inspection was passed. But what happens on January 2nd when the inspection is over? Here's what I expect to see. The institutions are going to try to re-peg the Western paper price to match the narrative. They're going to flood the media with stories about silver's strong year and how the correction was healthy and necessary. They'll point to the 150% gain and say, see, everything is fine. Meanwhile, the physical premiums in Asia are going to stay elevated. You're going to see a media blackout on the actual street prices in Tokyo, Kuwait, Singapore, because if the mainstream acknowledges that physical silver is trading at $100 while the screen shows 71, the whole illusion falls apart. I've built a dashboard of indicators I'm watching this week. Think of these as the canaries in the coal mine. First, the $71 floor. If silver holds at or above 71 for the first 3 days of January, the squeeze is still on. It means the selling pressure was temporary, just enough to pass the regulatory inspection, and now the underlying demand is going to reassert itself. Second, open interest on COMEX. This is critical. If open interest collapses dramatically, it means the big shorts have escaped into the Fed's repo facility. They've closed their positions using emergency liquidity, and the immediate crisis is over. But if open interest stays elevated, it means they're still trapped. Third, the repo roll. The $31 billion was provided on December 31st. If that number decreases next week, it means the emergency is over and the bank can stand on its own. But if the Fed has to roll that repo forward, if they have to provide another 20 or 30 billion next week, it means the bank is still on life support. The closet door is stuck and the mess is still inside. Look at the volume bars at the bottom of this chart. Notice how they disappear after the drop? The liquidity has vanished. That's not a sign of a healthy market. That's a sign of a market that's been artificially suppressed and is waiting for the pressure to release. So what am I doing with my own money while the system resets? I'm watching the $71 level like a hawk. This is the battle zone. This is where the rubber meets the road. Here's my conditional plan. If 71 holds through the first week of January, I'm looking to add to my physical exposure. I'll view this $71 price as a banker's gift. It's a temporary discount created by their own desperation to meet year-end regulatory requirements. If the physical market is trading at 100 to 130, and I can still buy paper silver at 71, that's an arbitrage opportunity that won't last long. But if silver dips into the 65 to 68 range on January 2nd or 3rd, I'm moving to a risk-off stance. A dip that deep suggests the selling wasn't just window dressing. It suggests a systemic bleed-out. It means the problem is bigger than one failed short position, and the system is still unwinding. And if we see another $30 billion repo injection this week, I'm sitting on my hands entirely. That means the closet door is stuck. The mess is still there. The bank that needed the bailout is still insolvent, and the Fed is just buying time. I don't want to be positioned in a market where the plumbing is leaking $30 billion a day. I'm not here to trade the noise. I'm not trying to catch every 1% move. I'm here to watch the plumbing. And when the pipes are leaking $31 billion a day, I don't want to be standing under them. My perspective is simple. The institutions control the paper price. They can move it wherever they need it to be for regulatory purposes, but they cannot control the physical market. They cannot print silver bars. And as long as the physical market is trading at a massive premium to the paper price, I know the paper price is artificial. The question is how long they can maintain that artificiality, and the answer depends on whether they can stabilize the bank that nearly failed last night. Let me bring this home. The screen said $71, but the system screamed $31 billion. The window was dressed, the mess was hidden in the closet, but the physical silver is still missing. The premiums in Asia are still real. The shortage is still real. They can manipulate the paper. They've proven that over and over again, but they cannot print the metal. And at some point, the physical reality is going to overwhelm the digital illusion. The new year has begun, and the real fight for the physical metal has just started. This isn't about whether silver goes up or down in the next week. This is about whether the Western paper markets can maintain their control over price discovery, or whether the physical market is going to force a reset. If you want to understand how these repo crises play out, go back and watch my previous video on the 2019 repo crisis. History doesn't repeat, but it certainly rhymes in the repo market. We've seen this movie before. We know how it ends. The question is whether you're positioned for it. I'll be watching those three indicators I mentioned. The 71 floor, the open interest, and the repo roll. And I'll be back later this week with an update once we see how the system responds to the first trading days of 2026. That's it. That's what I saw last night. That's what the data is telling me. And that's what I'm doing about it. The rest is up to you.